Good morning, good afternoon, good evening, and welcome to the TGI Friday. Thank God it's Friday webinar, the Bull versus Bear webinar for TradeDay.com. Steve Miley on the call. So, guys, we're going to go for our usual regular run through. First of all, sorry, apologies for a slight late running today in here. Just a little slow to get going today. So, my apologies there. A little technical issue as well. But here we are. Please pop any questions you have in the chat. We don't get much interaction with you guys. So if you are on live, please do pop something in the chat, anything you want to look at in here. And one of the things I want to really start off with and really focus on is just, the volatility is huge. We saw it yesterday, a massive sell-off, here on the S&P 500, 2.5%, 3% down, another 2.5% back higher in here. Nasdaq was like, over 3% down, rebounded to be up on the day by over 1%. You're getting like 5% moves like throughout, through the day in here for some of these major indices. Gold, explosive move to the upside, oil, massive move to the upside in here. So these markets are really moving now. Really would suggest you trading the micros in this situation, okay? They rather than the minis, gives you more scope. You can still build positions and build a bigger position, but gives you more flexibility. And trading smaller size, you can still, get decent profits in here by trading smaller size. It may then allow you to have a slightly bigger stop loss if you're trading a slightly bigger size, smaller size, than if you have a bigger size. So you give yourself a little bit more room on a trade. And then obviously your profit target is going to be a lot further away because the markets are really moving. So just keep that in mind. Something I really want to reiterate. We've been trying to stress it on the webinars recently. When we go into these more volatile times, reduce your trading size. It doesn't mean you reduce your profits because the volatility is that much bigger. And we're seeing people getting stopped out of positions and just trading too big a size really for what's going on with the volatility that's going on in the market. So let's take a look. We can go to I'm going to dip into the calendar, but really the market is not going to be focused on the calendar. You might get a slight move on the data in here today because it is important data, and I will just mention the data in here, the PCE data in here, the prices paid data, particularly on the PCE data, personal consumption expenditure data. The Fed tell us it's their preferred, it's that what they believe is the real underlying rate of inflation. It's their preferred measure of inflation. So it is important data. So we are definitely watching out for this PCE, core PCE data in here coming out today. We also got durable goods. This is just coming out in just under an hour. So we are talking at 8:30 Eastern time, 7:30 Central time. So do keep an eye out for that data. It could move the market because obviously there is is an important set of data. And prior to what we've got going on in Ukraine, the focus was all on inflation and interest rates. So, but really, the focus is going to be on the Ukraine situation right here, right now, and also then just markets adjusting to that. Yeah. So it doesn't necessarily mean we're going to need a new piece of news. It's like how the market's going to posture itself now going into today, clearly, and then obviously going through into the end of the month and then through into early March. So let's take a look at some of the headlines. Nothing, stocks rise after Ukraine panic, oil back below $100. So a lot of the moves we discuss, and I have been flagging this, guys. We saw back on Monday, Tuesday, when first of all, there was a clear intention from Russia to support the breakaway regions of Ukraine. Markets sold off and rebounded. When we get these pieces of news, the market is often, we have this sell the rumor, buy the fact, or buy the rumor, sell the fact. And in this case, sell the rumor, buy the fact on stock indices. Markets selling off aggressively yesterday on the fact that we got the escalation, we got the invasion started. And I've stressed this before. I've done the studies. I've gone and looked at, you've heard me talk about it, Pearl Harbor. You've heard me talk about Gulf War I, Gulf War II. I went and looked, and when the bombs start falling, when the actual conflict kind of really engages, and when we get that extra step into a more negative, what's deemed as a more negative situation, the market obviously often turns around and rebounds quite quickly, sometimes on that very day. And that's exactly what we saw yesterday. Oil above $100, gold spiking up close to $2,000. Huge moves on the market. Stock indices down. The DAX, the German DAX index, was down like 5% at one point. Nasdaq over 3.5%. Nasdaq ends up the day up 1.5%. 5% rebound from the lows. So it was an 8.5% day yesterday for the Nasdaq. 3.5% down. back to get the 3.5% back and 1.5% up on the day. So it's 8.5% round trip that the Nasdaq did during the day. So and I did put in the chat yesterday, guys. Part of the reason for that, is one. All right, yields. Obviously, let's go and just dip into the bond chart. Where did bonds go? Bonds spiked higher in price, lower in yields. So lower yields. This is going to reduce the threat of the Fed going more aggressive than we already anticipate. Right? Been looking at the countdown to the Fed. Yeah, look at it in here now. 83% only for now for a 25 pip basis point, 25 basis point 0.25 increase now at the March meeting. This was up at down at 60% with 40% risk for a hike of 50 basis points, half a percentage point, right? So there's real fading threat of that now. So it's going to put the Fed more likely to be more gradual in their approach to increasing interest rates because of the negative pressures that the conflict and the invasion in Ukraine is going to put on global trade. And the sanctions on Russia are going to impact global trade. Okay, and so that's going to put a negative on the global economy. But it could also put upside risk to inflation. Okay, so the Fed might need to address that, as will other central banks. But so three reasons really. I kind of really highlighted yesterday for the Nasdaq, the tech sector leading the market back higher. The tech sector doesn't like the tech sector is full of growth stocks like a low interest rate environment. So the fact that we're maybe going to see the Fed step from more hawkish to less hawkish, so less hawkish de facto more dovish. It doesn't mean they're going to be lowering rates. It doesn't mean they're going to be any particularly more dovish, but they're going to be less hawkish, which is like de facto less dovish. So for that reason in here, less hawkish, more dovish. So because of that in here, that's a positive. So the interest rate aspect of more of a positive for the tech sector because growth stocks, a lot of the tech stocks, the Nasdaq is full of growth stocks which are more sensitive to higher interest rates here. So that has certainly helped the rebound yesterday. Plus, you've got a lot of global brand names in the Nasdaq as well. Okay, so there's almost like a bit of a flight to quality into the Nasdaq. Okay, names like the FANG stocks, your Facebook, your Apple, your Amazons, right, your Googles, right. These are big global names. Okay, they're big. They're kind of safe stocks as well. So there's a part of the reason that the Nasdaq came back so well is because of that as well. So those are certainly two factors in here, and also the fact that the Nasdaq, the tech sector, those big tech stocks have been hit significantly on the downside. The Nasdaq, I think, has hit basically yesterday hit 20% at one point on an intraday basis, 20% down from the peak. So the Nasdaq in here, 20% down from the peak. Go take a look at that. I don't know if we've got the measuring tool in here, but the Nasdaq in here, 20% down from the high, I think, in here at some point yesterday, down here. And we looked at this, I posted it in the chat as well. At one point, this was a really strong hammer candlestick. In the end, it ends up closing all the way up here, super positive candlestick, a massive rejection of the downside in here. I don't think they have a measuring tool. Not seen it if it is on here. No measuring tool in here. But the Nasdaq in here, certainly what we've seen in here over the past 24 hours is a significant rebound, a rejection of the downside, and for those three reasons, that the growth stocks in here, the tech stocks in here, undervalued. They've had a significant sell-off from the high, more than the broader market. Okay, so undervalued. They're also growth stocks, which the potential for not as aggressive a Fed. That's positive for growth stocks as well. And then also there's some big brand names in there as well. So all of that adding up to a more positive. And look at that. That's a massive candlestick. I mean, I can't stress, I've been doing this a long time, guys, 30 years. You don't get candlesticks like that very often, right? A massive rejection of the downside. And we saw it, back here, back in January. The market then went and did go and retest, but then eventually pushed back higher. And then this is then the development. So this was the sell-off we had for January with a more hawkish Fed. The market then did rebound, and then we get again more hawkish Fed. And then this sell-off is all to do with Ukraine, okay? And particularly from the last week, obviously. But that's a really strong turnaround. Now, it doesn't necessarily mean we're going back strongly to the upside, but I think the downside risks are really limited in there now. And it's similar with the S&P. Look, a really strong candlestick. We undercut the low in here from January, but look, you undercut the low and didn't close below that low. We managed to hold above it back on Wednesday, and then yesterday down below it and closes way above it. So that's a positive candlestick. Now, if you go and take a look at my reports in here from that have been published, I'm still kind of looking at this from a negative aspect. But if we can get above yesterday's high, so if we just step in now on the S&P 500, so there's yesterday's high, and you can see, look, there's this trend line. Remember, we've been looking at this trend line that comes down from the middle of February, from the 17th. Okay, the market kind of pierced it, played with it, and then as now yesterday on the rebound got back above it. I would also suggest we could redraw this trend line. So that's an important trend that's already been breached, but I would also suggest now we can go in and draw the trend line off of the high there, and now draw it off of the previous high here, this failure high, and we'll extend it out. And look, we've just faded there yesterday and back from below it. And you can see actually used, so this old trend line in here that the market pierced here, and then faded back down below this old trend line. You can see it's using the underside of that old trend line as support, weirdly yesterday. So kind of seems to be respecting that old resistance now as support. We also going to look in here and step in what it defended. If we look at the Fibonacci retracement of yesterday's rebound, so this is just the rebound from yesterday, and you can see the market held above, went below the 23.6% retracement on the dip back lower there, but it's held above the 38.2. So the rebound from yesterday is intact on this setback. And look at this redrawn trend line. So this trend line here comes off the peak there from the 17th and through this peak in here from the 23rd. And you can see the market got close to it yesterday and then just faded back overnight after the market closed. The only thing that stopped this going any higher was the market closed, really. It was a really strong close. It drifted back after the close, slight dip, and then a decent rebound in here this morning and back up to that trend line. I think if we can get above this trend line, so that trend line is just above the current high for where we are on this current bar. So that's 42.76.5. We can get it back above like 42.80. Got a little high there as well. Where's that one? 42.78.5. Through there, it's going to be positive. Up through yesterday's high, that's at 42.90. This then looks really strong again. Okay, so up through yesterday's high is going to be maybe the next trigger on the upside. Could come through the PCE data. So going to be watching that. Might be on the cash equity open. So watching out for that as well. But for me now, tentatively, I've said in my reports, tentatively bearish, but I'd written that, on the close last night. Look at I think this is quite positive price action in here. It's what I would call a high level consolidation. The market's had this explosive, so we had a massive sell-off, a massive rebound, and then you've had a slight dip and a decent rebound in here. It's what we call a high level consolidation. It's almost like a flag pattern. You've got this impulsive move higher. So we just step in to where are we? We'll go to a 15-minute chart. You've got this impulsive move here. And then you've got this flag pattern. And you can see if we look at this as like, whether it's a flag or a pennant or whatever it might be, we've already gone back above this kind of counter trend line for the flag. So you'd argue there's in here. Let's leave it like that for now. So yeah, we're back above that already. So then we've got now, if you're on the 15-minute chart, a succession of higher highs and higher lows. Higher high, higher low, higher high. So pointing to the upside in here for me, I think real risk, back above these peaks here, the current peak on this bar for the last 15 minutes, 42.76.5. You've got this failure peak there, 42.78.5. Actually, 42.80.75, I think, in here. 42.80.75, and that peak there, 42.78.5. I think through 77.78 in here, this starts to look really bullish on the S&P. Nasdaq going to be similar. So there's the really aggressive rebound for the Nasdaq. In here, step in even to 15-minute chart for the overnight. There's the impulsive rebound, super strong, and then you've got again you'd argue kind of. We can do this trend in here. You've got kind of a flag pattern going on in here as well. And the market holding the bottom of the flag and now back above the flag. So all upside in here. And, got really close to the overnight high. Up through the overnight high, 13.983 1/4. Sorry, not the overnight, yesterday's high. This looks super bullish again in here. So it's certainly shifting from more bearish to more bullish in here, given the resilience that we've seen in here overnight. Let's take a look, at the a couple of the commodity markets in here. So gold in here, I mean, super aggressive on the upside and as equally aggressive setup, and then a really firm rebound kind of. So it was a very indecisive session. If you go and take a look at the daily chart in here for gold, I mean, look at that. It's a doji pattern. You don't see charts like that very often, right? I mean, massive on the upside. Then it goes retesting. Actually broke back lower down through the lows for the previous 4 days, and then rebounded back higher. It's a massive doji. Okay, doji, and a sign of indecision in here. And then look, another doji in here again today. So stepping back into the 1 hour chart, my jury's out on this one. It's really, really tricky. We risk on, risk off in here at the moment. The stock's trying to tell us we're back to kind of risk on in here, looking for the more of a significant rebound. But I think it's a really, really, really tricky one in here to play. You hold a gun to my head. I'm still playing from the long side. You've had a massive back sell-off. It went down through these supports and it came all the way back higher, and it's rolled back lower this morning. Look, and trying to rebound in here this morning. If we take out the low on this last bar, so that low there is 894.5. It looks more bearish. I think you've got to wait for it to get back above this peak in here, the overnight peak. That's at 1925. So I think 1925 and 1894.5 will be my breakout parameters. In between, it's kind of decide is the next leg here or is the next leg all the way back down here? And I think you've got to wait for a breakout there to kind of decide. Let's take a look at oil. And again, look at that. You'd have to say this, you'd argue this one in here is a really negative candlestick, but it's held above the support. The swing low from the day before, Thursday, whilst it's above the swing low, and then look today, it's tried to rebound. So a big rally, big sell-off. This is what we would call a gravestone doji, either a gravestone doji or shooting star candlestick, either which way. It's a negative candlestick and looks really, 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 really negative. However, look at the price action. We held above the Thursday low, and then we've held above yesterday's low so far today. And if we step in on oil, to the 1 hour chart, so there we go. There's the super strong rally sell-off, holds above Thursday's low here, holds again in here. So another dip and then a rebound. Again in here, breakout parameters, either the current setback low or maybe the low from yesterday. You probably want to see it all the way back above here though before I go long. It's a really tricky one and probably leave this one away. I mean, the cleanest trade really is looking at the equity markets. This looks a bit more tricky in here. I think you hold a gun to my head here, I'd be buying it. I'd be looking for upside in here, looking for the market to hold that low with a stop either below this low or from last night's low, today's low or last night's low, and entering long pretty much in here. Let's step into a 15-minute chart, get some more from that. So there's the sell-off. There's the strong rally, breaks $100, comes all the way back in here, holds above the low from Thursday, rebounds, fouls, and then is rebounding again in here right now. I mean, that's not even giving me any more clues in here on the 15-minute chart, sorry. I mean, the only thing you might want to look at in here is this bigger down trend line that comes off the high from yesterday and then down through that peak there. And then it doesn't really work because it cuts that high, so I'd probably draw off this secondary high. And let's see if it'll allow me to. There you go. Maybe back above that trend line. And that trend line's coming in around $94. Back above $94, a break and hold above there. Then you've probably seen it back up to here towards 95.70 and then maybe even higher. But it's a little bit of a tricky one there on the oil side. So let's just take, look through the headlines. But I mean, there's nothing you don't know, guys. You just look at any kind of news wire. Stocks rise after the initial panic. So you get this dip and the rebound in here. And then we'll go and take a look at Bloomberg. US stocks futures parry losses, oil prices mixed. So it's a bit of confusion out there. Market bounce, extender strategies, commodities and safe havens. Global yields rises, rate high outlook resumes dominant row. So bond yields back to rising in here, and we saw that as well. If you go take a look at the bond chart. So bonds initially, we got the bond spike in here. spiking higher prices, lower yields, and then gave all the way back up, negative candlestick, pointing back now to the lower prices, higher yields, back on that inflation, higher interest rate route. Yeah, so not really much more to add in here, to be quite honest, guys. Do keep an eye on the PCE day to day. And then the other thing is the close. The close is going to be, important going into today. Be careful in that last hour of trading. The market could easily move aggressively in one way or the other. At the moment, all the threat is on equities is to the upside. Risk back to risk on. However. If who wants to go home over the weekend where who knows what could happen in Ukraine, and so are you going to get long liquidation going into the last hour of trading? So be careful in that last hour. Things could really turn around in here. So just be a little bit careful. Or we could get a further squeeze. You could get buyers come in and people not want to miss, fear of missing out, fear that, you've missed the opportunity to buy some of these tech stocks at, super low prices. And then you could see a squeeze back higher up in the market. So it's a really tricky one. You just got to follow the price action as it comes. And as I say, just to reiterate, guys, micros, trade those micros today. Yes, try and stay away from the minis. It's going to stay volatile. Going to wish you all a great trading day, TGI Friday, and have a great weekend. I'll be back with you with the Bull versus Bear webinar on Monday. Take care.